Welcome back, everyone. In the United States, the labor market is booming. The economy adding more than 300,000 new jobs in March, and that is well above expectations. Meanwhile, unemployment edged lower to just under 4%. Karina Mitchell reports from New York.
Yeah, so this was a really hot jobs report, and it echoes what President Joe Biden said earlier this week, which is that the U.S. economy is the best in the world. And this report definitely gave credit to that statement because the job gains were very broad-based. Just look at the healthcare space, 72,000 jobs added there. That's a big jump over the previous month. Government jobs, same thing there, increased by 71,000 jobs. Construction added 39,000 jobs. Leisure and hospitality added 49,000 jobs. So that sector is now back at pre-pandemic hiring levels. Now let's talk about unemployment, because that did edge down 0.1% to 3.8%. So of course the big question is now, based on this robust data that we got in this jobs report, what does it do to inflationary pressures, and how does the U.S. Central Bank respond to this data as far as the timing of rate cuts? Look, we're really in what many people think is a Goldilocks type scenario right now, because while labor is robust, wage gains are moderating, and that is the key data point that we should be considering, particularly in this report. Average hourly wages were up by 0.3% month over month, up by 4.1% year over year. That is going in the right direction. It's down from 4.3% that we saw last month. So wages are coming into check. The Fed ideally wants to see that number come in at around 3.5% year over year. Now look, the Fed continues to say that it is data dependent. A whole host of Fed speakers, the latest, Neil Kashkari from the Minneapolis Fed, says what's the hurry to cut these rates when the economy and labor is still so hot? So a strong labor market actually could buy the Fed a little bit of time to watch and see what happens to inflation, which seems to be edging higher. The fact employers are hiring means that they're not too worried right now about a downturn or a recession. But what this report also shows is that the timing of rate cuts are being pushed out further. The Fed swaps now shows that that first rate cut will come in September. Now, the timing of that is very interesting because it's just before the presidential election, of course. Typically, when we see rate cuts just before it sways in favor of the incumbent, so in favor of Joe Biden. However, there are analysts that say we will see no rate cuts this year because the economy is so strong, and that could pull in favor of the Republicans and the presumptive nominee Donald Trump there. But one thing is crystal clear. The CPI data that comes out next week will be closely watched by the Federal Reserve for signs of any form of re-inflation. Karina Mitchell, CGTN, New York.
Now, despite those strong numbers, layoffs rose in March to their highest level since January of 2023. The latest, Apple announcing it's going to cut 600 more jobs. That's after canceling a long-term project in California to build an electric self-driving car. It is the company's first major post-pandemic job cut, but the broader tech industry has been experiencing a wave of layoffs in recent months. Layoffs in March were led by technology and government sector cuts. Well, let's see how the market's responding to all this jobs information. John Tarrant reports from the floor of the New York Stock Exchange.
What a week on Wall Street, with Janet Yellen in Guangzhou and Beijing for high-level talks, Disney defeating a shareholder rebellion, and the March jobs report confounding Wall Street. Nobody could believe that there were 303,000 jobs added in the month of March, when only 214 had been forecast by the best economists here. On the markets, well, they were shocked, but they got over it in the anticipation of 2 interest rate cuts still before the end of the year, but now not beginning until September. So the Dow was up 0.8%, 307 points, 38,900 on the day, but negative for the week. The Nasdaq was up 1.2%, but negative for the week. The S&P 500 ahead by 1.1%, 57 points to stand at 52.04, with all 11 sectors in the green, but again, negative for the week. On Friday, Bitcoin down 1.2%. And there's really one big piece of economic data due out in the week ahead. That's on Wednesday, CPI, the Consumer Price Index, inflation paid by Americans in the stores and the gas stations. It's the next piece of the jigsaw puzzle for the central bank, the Federal Reserve. John Tarrant, CGTN, on the trading floor of the New York Stock Exchange.
Okay, let's get some expert insight into the latest U.S. jobs information. John Canavan now joins us. He is the lead analyst at Oxford Economics. John, welcome back to the program. We certainly appreciate you joining us.
Hi, Sean. Thanks very much for having me.
Okay, this is the 39th month of job growth. What does the continuing strength of the job market say about the overall economy? Does it back up what the president is saying?
It does. It does reinforce the fact that the economy is growing quite strongly. We saw that in the most recent upward revision to the Q4 GDP data. We also look for Q1 GDP to come in at a solid 2.5% on a seasonally adjusted annual rate. Just overall, the picture of the economy is, as people have described here, somewhat of a Goldilocks scenario.
Okay, but let's also calculate into this. Despite the higher than expected job growth, and I don't know anybody who expected to see 300,000 jobs created last month, but U.S. layoffs rising 7% in March. That's the highest level since January of 2023. How do we rationalize this equation, and are the continued layoffs expected?
Yeah, so they are, and I would note a couple of things about the layoffs. One, they are announced layoffs. They take place over time. They're not necessarily immediate. Sometimes announced layoffs don't translate into actual layoffs. And what we have found is that those who are laid off are relatively quickly finding new jobs. Now, it is true that continuing jobless claims, that is, people who are out of work and still looking for work for a longer period of time, are rising somewhat as well, but they remain at an historically low level. So the job situation, even accounting for some of the layoffs data, still looks quite positive, but certainly not as positive as it was a year ago. The job situation is clearly slowing. We're seeing a significant decline in the rate of people quitting their jobs as well, because they're not able to as easily jump from one job to the next. But this slowing growth in job growth, the slowing pace of job growth, is not a terrible thing, because it still allows the Fed to remain on track for at least some rate cuts this year. As you noted, the market has pushed back the timing of the cuts, but we still expect that there will be some rate cuts from the Fed this year.
Okay, let's take a closer look at that. Unemployment numbers went down in March, and people talk about Goldilocks effect here. Now, correct me if I'm wrong, because my childhood stories aren't as strong as they were when I was 5 or 6, but wasn't it one bed too soft, one bed too hard, and this one's just right? Where's the just right one? Because people are expecting half a dozen Fed cuts this year, and now they may get 2. Do you understand how people on the street could say, this is disappointing, especially hear a Fed governor say, what's the hurry? If I'm facing the kind of rate out there to buy a new house, I'm the one saying, well, here's the hurry.
Yeah, that's certainly true. As you noted with the Goldilocks scenario, not everything is just right. In the economy, not everything is ever just right. But what we are seeing at the moment is, while this strength will slow the pace of Fed rate cuts, we still expect that inflation will gradually decline. It's been a little bit stickier from a services perspective than the Fed would have liked, but the trend remains correct. The trend remains towards lower inflation. We think that'll allow the Fed to lower rates this year 2 to 3 times, even if job growth remains strong. We think that their bigger concern is inflation. If they still see it approaching 2% or heading in that direction, they'll remain prepared to begin easing this year, even if job growth remains strong. That's their mandate. They have a full mandate, which is low inflation and strong job growth. So I don't think they'll be terribly worried about the growth in jobs, provided that wages continue to moderate, as we've been seeing, and inflation overall continues to decline.
Okay, now we've talked about it from the Fed perspective. Let's talk about it from the man on the street perspective. What do you say when you tell them, like, look, the Fed has this wait and see stance on whether it is going to cut interest rates moving forward this year, maybe September, maybe even after that?
Sure.
People are frustrated.
What I would say is, remember why the Fed is uncertain about cutting rates. The reason is that economic growth is much stronger than anticipated. So the reason is very positive for the man on the street. Although the Fed may not cut rates as much as expected, and maybe that means some things like mortgage rates or automobile rates may be, automobile borrowing rates might be slightly higher than people would like. It also means that job growth remains strong. It means that earnings remain strong. So if it costs a little bit more for a house, it also, the benefits are that you'll remain at work. The benefits are that you will continue to see your wages grow.
Sure.
So there's a lot of positive that is behind the Fed's not cutting as quickly as much as previously expected.
I think the markets are backing you up. They're doing extremely well right now. John, always a pleasure to have you on. We certainly thank you very much and have a great weekend.
Thank you very much, Sean. You too.